Good morning, good afternoon, good evening. Warm welcome to the webinar on towards market transparency in smallholder finance. I will wait for 1 more minute for people to allow them to call in, as I think it's 3 o'clock sharp, and we'll get back to you in a minute, and then we get started. So warm welcome. I would like to kick off this webinar on towards market transparency in smallholder finance. My name is Iris van der Velden. I'm the Global Director for Innovation and Insights at IDH. And your host of the webinar for today are IDH and Dalberg. And as IDH, we are working together with the private and public sector to make supply chains and landscapes more sustainable. And our colleagues of Dalberg are working together with companies and organizations in achieving the sustainable development goals. And I'm pleased to be here and start sharing with you some of the key insights of a research piece that we did together with Dalberg, but which has been supported by the MasterCard Foundation Rural and Agriculture Finance Learning Lab. Both support from a financial perspective, but also they have been instrumental in co-implementing the research piece that we have done together. Today, I have with me Kusi Hornberg, who's the global knowledge lead at Dalberg, and my colleague Clara Colina, who's the program director for the FarmFit Intelligence Center. Let me take you along in where this journey started. So we started this work as IDH. We started this work quite a while ago. So we started our work on creating more data-driven insights in how business models work when companies work with smallholder farmers, I think back in 2015. We then looked at business models of supply chain partners. We realized as the finance gap is huge for smallholder farmers and SMEs, that it could be very interesting to also look at the business models of financial service providers. And this is where we teamed up with Dalberg and with the RAF Learning Lab. And we said, let's see whether we can develop a methodology that allows us to get insights into whether financial service providers are able to run a commercially viable portfolio with smallholder farmers. Because we know that agriculture is being perceived as high risk and high cost. We thought if we can create more data and more proof points, that this can actually help to understand how to improve commercial viability, but also how to further drive impact for smallholder farmers and their ecosystems. So what are we going to do today? We have been looking into a handful of financial service providers, how they're performing and how they can improve. And we will share the key findings from the report, including some examples or first pathways that could be explored to make their business more sustainable and impactful. Secondly, we would like to have an open and honest discussion to what extent there is a real business case for smallholder lending, but also looking at the social value it can unlock. And we want to make sure that there is some open reflection for practitioners on what you can do with this. So if you're a financial service provider, what can you do with these type of insights? So that's the third thing we'd love to achieve today. So what does this mean for the coming hour? Well, you first can expect a presentation by my colleague Clara on some of the key research findings. Kusi will moderate I think, an inspiring panel with 3 panelists. There will be room for interaction and question and answers from the audience, and we will finish this 1-hour webinar with some closing remarks. Then I'd like to take you through some of the housekeeping suggestions. It's very helpful to keep yourself muted when attending the webinar and when not talking. And we have 2 tools that you can use. So there is one Q&A tool here in the Zoom environment, which you can put your questions in, and there's actually a team that's ready to answer your questions. You can also use the chat tool to connect to other participants and other colleagues to share ideas. But for questions, please use the Q&A tool. Please note that we're have a streaming on YouTube, and this session is recorded. I'd love to hand over to my colleague Clara, who will share with us what we learned, what our early insights are from working with these financial service providers. Clara, the floor is yours.
Thank you, Iris, and thank you everyone for being here today. I am Clara Colina, as Iris has introduced me. I'm Program Director of IDH FarmFed Intelligence Center. Coincidentally, I used to be Program Manager for MasterCard Foundation RAF Learning Lab, so I've been following this work for a while now. I'm really excited to be here today and to see a lot of new, but also a lot of very familiar names in the audience. So without further ado, I'll jump into it. So what's going on? So taking a bit of a step back on what's the opportunity that we're trying to tackle here. So smallholder farmers, as many of you know, represent a huge and underserved market for global social and economic outcomes. Globally, there are around 2.5 billion people that depend on smallholder farming for their current and future livelihoods. That's the equivalent of 500 million farm households. Together, they're producing around 30% of the world food supply, and they lie at the intersection of a much wider impact agenda, touching into gender, youth, employment, nutrition, and climate outcomes. As a result, and probably not surprising, agricultural development is estimated to be over 3 times more effective at reducing poverty in low-income countries than investment in other sectors. But despite this pivotal role, most smallholder farmers continue to be trapped in cycles of poverty. They lack access to the productive assets and services they need, be it land, be it finance, labor, inputs, markets, to improve their productivity and improve their livelihoods. There are many reasons behind the lack of access to productive assets and services, but one of them is the lack of access to finance. Approximately $170 billion of the annual demand for smallholder finance, both agricultural and non-agricultural finance, goes unmet, leaving farmers without their inputs, the services, and the technology they need. I've personally been following this smallholder finance gap for a while now, for almost 10 years, and we've seen a lot of good things happen in the last 10 years. There's a new wave of financial services providers that have entered the market, driven by technology, by a shift towards more market-based approaches. But the reality is that capital is not entering the market at the pace that we need. For bluntly put, for any lending opportunity or any investment opportunity worldwide to make sense, the revenues need to outweigh the costs. And for most financial services providers today, they just simply want to put their money on what they think could be or have more certainty over the return of their investment. So are these perceptions right, or is there a different way that we can put into perspective the perceived cost and risk with the potential financial benefits and social impact that it may unlock? This is exactly what we want to do with you today. But before we do that, we would like to hear from you. So if I could ask everyone to go onto menti.com and then use the code that you find there to answer the extent to which you agree or disagree with the statements that you'll find, you find in the screen, and you'll find when you log into menti.com. And then I'll pray and see if this updates automatically. Okay, so I see responses coming in. Let's give a few. I see 10 responses already. More coming in. I see 15 responses. I'll give a few more seconds. If people are joining, we're on Zamenti.com. You can use the code on the screen to just do a quick poll and answer the questions there on the extent to which you agree with the statements. Okay, so interesting. It seems that collectively as a group, we seem to think that financial service providers do not understand smallholder farmers. That's really interesting because it's hard to imagine how you could have impact and capture value if you don't understand the clients that you're serving. So interesting there. We also, well, we're on a scale of 1 to 5, we're kind of like midway on whether there's actually a business case for the financial institutions. I think half of us seem to think that there is, the benefits outweigh the costs. Some of us think that there isn't, and it's actually skewing towards a bit towards there is not a business case. And then on the last one there, what we're seeing is we tend to think that even though this is interesting, even though there seems not to be a clear business case, we think that they profit excessively with little return for the clients that they're serving. So this is really interesting. And let's see, with this understanding of what collectively we perceive what the research showed, and then most, probably even most interesting, hear from a panelist of what they're seeing through their own experiences. So let's go and look first at the business side of the equation for the financial institutions. So generally speaking, what we saw is that balancing the revenues and costs in smallholder lending is challenging. Only one of the lending models we assessed achieved financial sustainability without subsidy. So pre-tax, pre-grant, net margin. All others made a loss and actually required quite optimistic assumptions to be able to break even. So what's behind these challenging economics? So there's a couple of big drivers. The first one is inadequate or small scale. Economies of scale are particularly important for this sector where the small loan sizes mean there's often very little revenue to cover the servicing costs of the loan. The good news of what we saw is that most of the organizations had a large fixed cost structure through field staff, technology investment, headquarters, and administrative expenses relatively to the size of their portfolio. The good news is that everything else being constant, if we increase the scale, all of them would be able to break even and reach those economies of scale. The question is, or the challenge is how do we actually scale? And then there were a couple of good lessons or success factors that came into play. One of it, which was maybe pretty obvious, is it really helps if you already have a farmer customer base. So those that already were interacting with farmers and added a lending product, because you're an agribusiness, because you're a mobile phone operator, had it really relatively easy. One of the FSPs that we assessed was able to reach over 200,000 customers in less than a bit over a month. The second, and if you have simple product that don't require a lot of capital investment that really increase your fixed costs. And the third thing that worked for scale was around the access to capital. And we'll see in a minute how important is access to capital for financial institutions and how it can constrain growth. The second one is the small loan scales. I've just almost referenced it. Essentially, the loan sizes were around from $70 to a bit over less than $1,000. A small loan size means little interest and fee revenue to cover the costs of servicing that loan. The third one, loan losses. This one was really hard to compare because of the differences in how different institutions defined their loan losses. But overall, what we saw is that on average, they tended to be higher than consumer lending in other sectors. And this was primarily for the variance. Where things are good, they tend to be even lower or around consumer lending, but it's those spikes when it hits the markets or climate shocks that the loan losses spike and on average tend to be higher. And then finally, the high cost of funds. On average, the cost of funds accounted for between 20 and over 60% of interest revenue. So really hampering down the profitability potential. And as I said, we'll jump a bit into what's behind an optimal capital structure and the relevance for these players. So with the challenging economics, it seems that subsidy can play a really big role in trying to achieve that financial sustainability. So in the left there, you see that when we added the grants, the subsidy money that these providers were getting, most of them were able to break even or gain a profit. There's a lot of subsidy has become a very controversial word. We'll be hearing from a panelist a bit on subsidy, but we need to also to recognize that agriculture continues to be a heavily subsidized sector, both in developed and developing economies. So it's more about how we deploy that subsidy and how we can use it effectively, something that Kusi and our panelists will explore in a bit. So now let's look at the other side of the equation, the farmers. So smallholder farming households perceive access to capital as a key driver of the success of the farm. We've interviewed almost 2,000 farmers across not only the assessments that we did for financial institutions, but the assessment that we've done with dozens of agribusinesses. And 75% of those farmers identify lack of access to finance as a key factor constraining their ability to purchase improved inputs. But we all know that credit is not a silver bullet for smallholder farmers. Credit is only one of the many factors that constrain their growth. They also lack access to training, to knowledge, and agricultural practices, to inputs, to technology, to markets. And without these non-financial services, what many smallholder farmers struggle is to translate the investment that they're doing in that loan into productivity and income gains. So what our research has been showing, and by the way, this data that you see here doesn't build only on the just 7 financial institutions that we assessed, but actually in over 30 agribusinesses that were offering finance within a broader variety of services. And what it seems to suggest is that those business models that combine finance with other services, and by other services here, we mean inputs, training, and markets, are able to drive greater farmer income uplifts than those that only offer finance or models that do not offer any finance, but just the complementary and non-agricultural services. So then what do we have? Economics are challenging, but the impact potential seems to be positive. So how do we solve this tension? Shall we just rely on subsidy, which we'll see that it has a big play? Or shall we look for other pathways? So our research suggested a few approaches to improve business model viability. One, be holistic. So really designing this integrated value propositions that can help drive traction. And if we do this in partnership with value chain actors, can also provide an opportunity to share cost and risk. Second, understanding our customer value. And this is not only about understanding the needs and wants, but also the value. What's the lifetime revenue and costs that I'll be able to get from a customer, and how does that influence the customer acquisition strategy that I'm going to put into practice. And the third one, I've already been touching on it as one of the key constraints: optimize the capital structure so that we can maximize long-term returns and resilience. I'll try to go quickly through each of these. So in terms of being holistic, what we've seen in the last decade, it's a big surge in the popularity of holistic value proposition. And as a reminder, holistic value propositions, we mean those that combine financial with non-financial services. From a farmer, we just saw, right? They make a much more sense because they have a lot more needs than just finance. But from a business model perspective, they can also bring a range of benefits to both financial institution and value chain actors. For financial institutions, it enables them to increase margin for a variety of reasons. One, because it makes the smallholder lending itself more attractive. A farmer that gets training, a farmer that has access to farmer is a farmer that is less likely to default on your loan. It allows me, if I'm doing this in partnership with a value chain actor, it allows me to share the cost, share the risk, and manage operational complexity. But if I'm doing this in a partnership with a value chain actor, it actually opens up the door to finance not only the smallholder, but finance the entire value chain, starting with that agri-SME that I may have partnered with. For the value chain actors, these partnerships are often hard to land, but can bring a range of benefits. They mostly recognize that there's a lot of value in offering finance, and that it's really hard for them to offer this finance off their own balance sheet. They often do not have the capital capacity to do this, or the expertise in managing financial operations. And it can bring a range of benefits. Let me go through a bit of an example of some of the things that we saw during our research. So for instance, for an input provider, partnering with a financial institution and selling to customers that have access to finance actually resulted in more new customers. So new customers, the customers that they had were more loyal, and often there were larger ticket sizes. So now my farmers were only not purchasing my fertilizer, but my fertilizer and my pesticide. Income uplifts of up to 105%. Buyers, a more productive farmer, greater sourcing volumes, and often high quality volumes, which led to quality premiums, uplifts of over 25%. So if well structured, these partnerships can really benefit both financial service providers and the value chain actors. Second, understanding the customer value. Across all the financial institutions assessed and many of the agribusinesses that we are assessing, the number one priority is growth and getting more customers. But with what customers should I grow? So we've seen FSPs making a lot of investments on trying to understand the needs and wants. So we said in this poll question, they don't understand. Well, we've seen a shift in the trend here, investing a lot of customer research, human-centered design in understanding the needs. The next step, though, is to really quantitatively understand the value that a customer can bring by understanding how much revenue is it bringing me across the lifetime. If it's going to be 5 years with me, how much revenue does it bring in those 5 years? How much I'm going to spend in serving? And then how does it relate to the investment that I made at the beginning to acquire that customer by the marketing, onboarding, etc. So I'll show you an example of something that we saw for one of the financial institutions that we work with. So there was 3 segments here. A segment A, that was a passive saver, just saving with the financial institution, not doing anything. A segment B, that was actually saving, but using those savings to purchase inputs that were facilitated by the financial institution, and they made a margin. And the segment C, customers that were actually saving, but also taking a loan to buy inputs because their savings wasn't enough for the amount of inputs that they wanted to buy. And what we see in that graphic is that only segment C is profitable. Well, only with segment C, I will ever be able to make the amount that I invested in acquiring that customer. The question then is, how do I subsidize in perpetually segment A and segment B? And in that case, how can I grow segment C so that more cash flows into segment A and B? Or how do I tweak the economics of segment A and B so that they at some point translate into profitable customers? And then finally, optimizing the capital structure. We saw that by making relatively, at least theoretically, straightforward tweaks, in the practice, everything is more complicated. On the capital structure, we could see uplifts on the return on investment on the return on equity, my apologies, of up to 14%. And there's a couple of key lessons here, and that our panel will explore a bit more. Ensure flexibility, right? Lines of credit versus long-term debt that is very hard to match to the seasonality and short-term needs of the smallholder farmers. Balance different types of capital. You can see that more in the brief, all with its pros and cons, subsidies, commercial, blended. Manage investors, really get investors that buy into your business model, that understand it, because they will be the ones that will back you up when times become complex. Mobilize savings, pretty obvious, but if you're able to mobilize savings, your cost of funds drastically reduces. And then finally, manage the currency risk. Often, a lot of these financial institutions funding themselves in USD and Euro, but lending on local currency. So a big role there also to play by investors at the higher level. So that's a lot, but there's more. And if you want to know more, just visit the product online. You have the link there. And hopefully one of my colleagues is sharing it on the chat. I'll share it myself in a few moments. So with that, I'll give the floor to my colleague Kusi, who we've worked in the past really close, and really happy, Kusi, to have you here and get an opportunity to work together again. And with that, over to you.
Thank you, Clara. And hi, everyone. Great to be with you today, this morning, this evening, wherever you are in the world. Thank you for joining us. I have the distinct pleasure of moderating a great panel we have, and I'll ask our panelists to come on video. What such fascinating research, the product of 4 years of work, and many people, I think, joining us today were involved in that work. So I just wanted to give a shout out and thanks to all of those people who are involved in producing what I think is really useful insights. So we're going to have a discussion now with my three distinguished panelists. We have Esther Kariuki, who is the head of agribusiness at the Cooperative Bank of Kenya. Hi, Esther. Thank you for being with us. Hopefully the rain has let up a little bit. We have Hilary Miller-Wise, who is the deputy director at the Bill and Melinda Gates Foundation, and also the former CEO and founder of Tula. And then last but not least, we have Roel Messi, who is the CEO at the FarmFit Fund. So we have actually quite a diverse set of perspectives here. We have a FSP perspective from Esther. We have a sort of a donor slash fintech perspective from Hilary, and we have a sort of a funder investor perspective from Roel. So I'm gonna kick us off with a question, and I'm gonna start with you, Esther. And the question is, Clara pointed out that it seems farmers, particularly the smallholder farmers, are benefiting significantly from these arrangements where an FSP is working with a value chain partner to provide a bundled set of services, finance, access to inputs, technical assistance, etc. Does that resonate with your experience at Cooperative Bank? Are you seeing smallholder farmers benefiting from the credit and other services you're providing them?
Thanks, Kusi. You can hear me? Yes, okay. Yes. Yes, thank you. Yes, I think at Cooperative Bank, these findings actually resonate very well with us. As as we may all know, or perhaps not, Cooperative Bank is a bank that is owned by farmers who are organized in form of cooperatives. So the farmers came together and in 1965, 1968, opened the bank because of these challenges. They knew and they experienced the challenges of trying to get financial services from regular banks, and they could not, and they decided to just come together and form a bank. So one of the things we have done as a bank, because we do know that we don't have an option of not servicing them and coming up with products and advancing credit, because that's why they started the bank, is see how we can develop sustainability in our model by partnering with other value chain players. We are just a speck, or we are just one of the pieces in a farmer's ecosystem. So we have valuable partners that we work with. For instance, in dairy sector, we work very closely with Brookside Dairy, one of the largest dairies in Kenya, where we do capacity building together. So we bring farmers together in a demo farm, set up demo farms. We share the costs of running the capacity building programs. Brookside comes in very strongly to train farmers on the dairy the technical piece of the dairy farming, and we come in to support farmers with the financial governance, financial literacy, corporate governance, and then Brookside also buys the milk. And when we advance the credit, then we're able to get to deduct our loans and give the farmers the balance. And that has seen us service over 80,000 farmers organized in co-ops and give them all manner of credit, from the capex credit to set up the cooling centers, the transport, milk transport, to the collection centers, to some even transiting to set up very robust dairy processing and becoming actually competitors of Brookside. So that model works very well for us.
Thank you, Esther. Actually, I'm going to stick with you for a moment. So clearly you have a model that's working, you're scaling, but curious how the farmers are benefiting. Have you actually looked at, what the benefits of the farmers are? And also, I know you also have a sort of a gender sort of perspective. The report does highlight does a deep dive on gender and youth. And I'm wondering if women, how they're benefiting or not from the services you're providing.
Thanks, Kusi. So from that, then obviously what we have then done is, because we are coming in as partners to educate the farmers and to create that capacity to understand the women of inclusivity in the cooperative. What we have seen in many of our cooperatives now even becoming more, the norm rather than the exception is cooperatives having women in leadership. We initially go to a cooperatives meeting, and you'd find when we go to the farms to do the actual training, where the farmers come, you find more women than men come for the actual training. But when you go to the boardroom on the governance of the cooperative, you find it's just the men. And so by educating the men and showing them the importance of having the women on the table, and also this helps them attract other partners who have a gender focus to come and support them, whether it's from government or non-governmental organization. So Kusi, we are seeing a lot of the cooperatives starting to incorporate women and youth in the leadership than just in the production.
That's a great example. So it's not just livelihoods, it's also empowerment in some respects. Great, thank you, Esther. Hillary, I want to turn to you. You saw the data that Clara presented, right? Clearly there's big sort of income increases in working in these sort of partnership arrangements. Does that finding resonate with you, that the farmers are benefiting from these sort of models? And if so, what does that say to you from, I guess wearing a little bit of your donor hat now? Does it justify a case for donor support?
Yeah, thanks, Chrissy. I think what's challenging, as we all appreciate, agriculture is incredibly complex, right? And when we talk about smallholder farmers, there are so many different segments, there are so many different variables that go into that question of whether financial services will have an impact. So yes, the data that Clara presented was very clear and very encouraging. If you look elsewhere, you'll find data that is very mixed, right, on the impact. JPAL, I think about 5 years ago, did a review of about 9 RCTs that were focused on credit for smallholder farmers. And the results were very mixed, and it depended on the crop that the farmers worked in. It depended on the type of loan that they got access to. Was it timed to the cash flow of the crop? Those loans tended to be better. But what they found is, more often than not, the farmers did increase productivity, but they didn't increase income. And there are a number of reasons for that. It could be that within the household, because productivity is increasing on the farm, people start disengaging from other work, right? So maybe some of the informal labor they were doing, they stop doing that and they dedicate more to the farm, but it's not compensating, right? The income then is not compensating on the farm for the lost income from other areas. It could be that the access to market is really poor, right? And so productivity is increasing, but they're not able to increase net income. And so I think what makes it really confounding for donors and investors is to navigate through those very complex waters and to figure out what is the right combination of farmer profile, of market, of capital structure, of product design that will actually result in both increased income for the farmer as well as positive returns for the lender.
Thanks, Hillary. I'm going to stick with you a little bit on that since you opened up the topic. I mean, yes, it's a messy space, right? And there's mixed results, and context matters a lot. Yet it seems there is, at least our study is suggesting there's some evidence that it can work given the right circumstances, right? So how do you respond to that from a donor hat? Like, is the case strong enough for you, or do you struggle internally to make the case, or what does that mean, or what is that, both having lived experience and now wearing a donor hat, how do you translate into the messiness and how you sort of take a step forward?
Yeah, no, that's the right question, and we remain very focused on facilitating access to finance for smallholder farmers. There's no question. So even with the kind of messiness of the data, we're still very committed to it, because I think the preponderance of the data does show that if you can get the targeting right, then you can then realize that outcome. I think it, though, does require a more nuanced view of the market that you're working in, right? And not to think about smallholder farmers writ large, but to understand the difference between farmers in a high value export crop versus farmers in a staple crop, for example. To think very differently about the product design, right? Is the product actually tailored to the cash flow of the crop, or is it a kind of traditional, right? You pay every week or every month, or whatever structure there might be. And so it just requires you to get much more in the weeds and understand all the different levers that could be pulled to both mitigate the downside risk of getting it wrong, but ultimately, obviously, to try and drive that positive impact in terms of net income.
I like that. So lean into the nuance, right, and get it right where you can. Great. I want to turn a little bit to the financial services providers now. And that graphic, the first graphic Clara showed, is sort of like the main output of the work, and it's quite startling, right? 6 of the 7 financial service providers did not break even without subsidy. Yes, with subsidy or grants, they're breaking even, but without subsidy, they're not breaking even. So Roel, I actually want to turn to you as a sort of investor perspective. Is it possible to be profitable serving this market segment? And what does it take? What does success look like for you? And what do you look for when you're looking for opportunity?
Okay, thanks, Kuzi. Yeah, I can share my experiences. We started the FarmFit Fund and became operational early 2020. So the experiences are still young, and maybe based on the cases we met. I see a lot more interest to engage and lend to smallholder farmers with value chain actors, and that, I think, is very much in line with the results of the report, because the broader you define it, you go from finance only, very questionable business case. You go to bundled services, hey, this can work. When you go to a value chain actor, you open, let's say, the level of, or you increase the level of profit potential. You increase it, because you're talking about, what does the value chain actor earn apart from the economics of the credit or the services provided on the core activity, which could be trading maize, could be trading coffee, whatever. So the point of view from value chain actors is completely different than from financial institutions. What we see, and again, that is our experience, having talked, because when we started the fund has the vision that smallholder finance can become an asset class. Whether that's the case, this is really on the table today as well. Because we thought, banks are key to making this happen, and probably that's still true. But banks are very difficult animals, in particular the larger commercial banks, and obviously not the specialized agricultural banks, but because they have their systems, they look at collateral, they have their traditional distribution structures, and bankers, in all honesty, are also very traditional people, not very innovative. So what we do, we offer de-risking by substituting collateral requirements with the cash collateral, with first loss guarantees, junior loans. We also have a second loss guarantee backed by DFC. And often this is different, but it's still not enough. We still want to have the real collateral. So it doesn't always solve the problem. Going to the MFI sector, they're much more receptive, of course, in particular when it's a more rural-based MFI. But often the volumes there are much lower. But the willingness is there. And then also another reflection on the availability of affordable capital. Having engaged also with a lot of MFI organizations, we see that there is a small group of very well recognized MFIs. So, you call them the DFI darlings or the donor darlings. They have access to a lot of cheap capital without any strings attached. And I think, that's great. But the difference between the second or the third layer having no access at all. So let's say the reasonably priced capital is not there. And I think there we should work. And I think then I come to capacity development, technical assistance, and to some extent subsidy, because you have to develop this layer of MFIs so they get to maybe the first category or close to that, because otherwise you will never solve the problem. So I think that are my reflections of trying to work for 2 years with financial service providers. And by the way, we're now getting some traction finally, but we've done 8 transactions now. They're all with agri SMEs or with value chain actors. And maybe this year or next year, we expect some transactions with MFIs.
Great, thank you, Roel. That's super insightful, and I think resonating with the themes also of the study, right? Challenges of scale, challenges of the right capital structure, particularly more difficult for the less reputable financial and service providers, and then the necessity of that additional de-risking or value add services to make it viable. Maybe just stick with you one more minute as well. Sounds like you're starting to look, right, or you have been looking at this space. You have yet to make an investment into a financial service provider, but that doesn't mean you won't, and you want to. What would it take? What would you look for from an FSP that's serving this segment? Is there sort of a minimum scale? Is it that full package that they have access to cheap capital from other DFIs? What would it take for you to place an investment?
I think, obviously, let's say the hygienic requirements, there needs to be a proper capital structure of the MFI. We have to have proper governance, etc. The ESG aspects play a role, but this is quite evident. I think in addition, let's say we follow a value chain approach. So we look, where which farmers do they lend into, and is there a value chain to be identified? I think the other element is, do they segment? Indeed, what was analyzed in the report was also customer profitability on a sort of lifetime basis, and comparing it against acquisition cost. All these things play a role. But I think the most promising approach is working together, not starting at the MFI level, but starting at a larger off-taker and then going down the value chain, identifying the different type of suppliers. The supplier of, let's say, it's a trader. So you look at the agribusiness that supplies the trader, and then there may be another agribusiness. So you peel down the value chain and you look at where the bottlenecks, where is the necessity of liquidity and how we can solve that. Then you're going to the FSP and say, hey, we have here a value chain that makes a lot of sense. It's profitable. You can partner with that in providing the finance in a way that is much better structured and much more secure. Because that ultimately somebody, and that somebody is a very reputable, larger company. It can be local, but can also be international. Because that's the way to really de-risk. And what we would do is, okay, help them on the way. But I would say these are the approaches that in the end are profitable. So yeah, that would be my 2 cents.
Great, thank you so much. I really like that. So start with the anchor off-taker as a starting point, and then build the ecosystem around them. I want to shift back to you, Hilary. Now I want to shift your hats to your Tula hat, and I would love to hear your reflections on that experience, right? Particularly with this question of, is it viable for an FSP to serve this segment? What was your experience? What were some of the lessons learned you have from that experience? Yeah,
great. So I think one of the things that's important to think about is the stage at which we're looking at these companies. Obviously very early stage businesses are rarely profitable. And I think the question, and Clara pointed to this, is in time, what would you expect, right? Are they actually showing that they can scale such that, you know, their customer acquisition costs are coming down as their revenue is increasing? I think it's, as the report shows, it's very challenging to do without some sort of subsidy. Now, one of the issues that you have, at least in Africa, is until recently, sort of a huge flurry of excitement, particularly in businesses that look like platform businesses, and investment that's coming in at very high valuations, right? Which sounds like it would be a good thing. It can actually be quite dangerous for a company, because you then have to grow into that valuation. And when you're serving smallholder farmers, that's very, very difficult to do, to get, you know, very fast, very high growth to justify the underlying valuation that you got in a recent round. So, you know, this capital structure question, I think, is a really important one. A lot of the players in this space do have access, as Clara pointed out, to lower cost capital. But even with lower cost capital, if you're a lender and you're getting your cost of capital on average is, you know, say 10%, still you have to build the business for the future, which is presuming that in time, you're not going to have 10% weighted average cost of capital, right? And when you start looking at those figures, when it gets up to 18%, 20%, that becomes really difficult to make that a profitable business. I was pleased to see in the report that, you know, businesses that do actually have a number of different services and are sort of bundling services as opposed to just the pure finance seem to have more potential. I think at Tula, that was, you know, one of the bets that we were playing, is that by having multiple revenue streams and not relying solely on the margin on the loans, that was a better bet to place than purely a lending business. But even with that, as Clara pointed out, small loan sizes, you know, clearly these businesses are social impact businesses, and so you don't want to be charging usurious interest rates, right? You're trying to counter what is common in the market. You do really get squeezed, and often grant funding can be a way to lower your weighted average costs of capital over time. So I think as an industry, we need to talk about subsidy and the role that subsidy can play in the long run, and make it less of a dirty word, as Clara alluded to in her presentation.
Thank you. Great insight, right? So scale is necessary, but sometimes expectation of scale and the pathway to get there, particularly when you're doing fundraising as a startup, makes things really challenging, right? And then, yeah, grants can help you get there, right? In some sense, and sometimes some, I guess, providers don't like to even use that word, and others are willing to sort of lean into it. But unfortunately, the latter type there's many fewer. I want to turn a little bit. Yeah, go ahead.
Sorry, I just was going to add to that quickly, Kusi. Yes, grant funding can help you get there. The problem that a lot of these businesses find is that there are many investors out there that don't like to see grant funding on the balance sheet, right? And so you need it in many cases, but you're going to run into a problem when you're trying to raise commercial capital with some players who think it's a signal that you're not a commercially viable business.
Double-edged sword, right? You're damned if you do, you're damned if you don't, right? Great. I want to turn to you, Esther, in a moment, but I also want to remind everyone in the audience to start typing in your questions. We'll get to you, or sort of public questions, in about 5-10 minutes. So if you have a question, please don't forget to add it into the chat box. But Esther, I want to hear from you. What's your experience? Is it viable? Is Cooperative Bank, you know, lending to, you know, those 80,000 customers, I guess, historically, has it been sustainable? And, you know, what has been sort of critical for I think, the success you've had?
Thank you, Kusi. So we have about direct beneficiaries of the financial services that we administer in the cooperative, agricultural cooperative, about 3 million farmers. That is directly to the farmers' cooperatives. But we also have the savings and credit cooperatives, what we call the MFIs, that we also do wholesale lending so that they can then retail the credit to the farmers. So we are looking at about 5 million corporate members of cooperatives who benefit from credit that we've been doing. And I also want to state that for us, it has been a profitable and sustainable business, but there were times when it wasn't. In the late 90s, early 2000s, it was extremely unprofitable, also threatening the very strength of Cooperative Bank. So what then we did was obviously realize that we cannot just stick with farmers at the production level and expect to really make a sustainable business. So the holistic approach then really works well for us, because we are able to make to compensate the losses that we get from one aspect, maybe some lending, from the other transactional income that we're able to get from the farmers. It also helps that we get more customers from the value chain that the farmers are involved in. So on a net basis, when we have the ecosystem lending to a particular value chain, you see from a net position, the approach made sense. But if you're just stuck with the farmers in their corner, then you're stuck with the risks, the cost of credit. Then it may not be a very sustainable approach. And also look at the issue of the risk premium. If we work with partners, and also, like we work with USAID, the USAID has given us a guarantee scheme, the DCA program, where we are able to lend without asking farmers for collateral. And that in itself, when we also fix that in the entire ecosystem, value chain players, then we have USAID, we don't have to ask for as much collateral as we would want to. So we are able to even lower the cost of the loans to the farmers, and therefore enabling them to gain a little bit more from their enterprise. So I think for us, Kusi, our business is that's our business, the cooperatives, the farmers. And I think we figured out a way to work with farmers, lend to farmers in a sustainable way, and their ecosystem and their other partners in the space.
Fantastic. I mean, a great success story. And the 3 million farmers, I think you have scale. So you're actually, everything you just said speaks to all the things I think the report finds, right? You have sufficient scale, you do a holistic sort of bundling of services, you have partnerships with off-takers, and I'm actually going to ask you about that in a minute. And then you also have grant funding, right? In some sense that makes your capital structure somewhat subsidized and makes it easier to maybe go to market segments and serve customers in ways that are more holistic as well. I want to ask about the partnerships, right, with value chain actors. Can you tell us an example of how you're working with, I think you mentioned at the beginning with Brookside. So how critical, and also Roel touched on that, sort of he would start with the value chain actor. What's the role of the value chain? Are they benefiting from the partnership? And how do you see that?
Yeah, and maybe even just another example, in the potato value chain, there was a huge discussion recently on the fact that KFC opened up business in Kenya and they could not get potatoes from the Kenyan farmers. And we got together with partners, the Agrico PSA, that's a certified seed company from Netherlands, with Yara East Africa, that's a fertilizer company, with Bayer East Africa for chemicals.
Oh no, looks like we've...
By contract. Oh, sorry. Am I back?
You're back.
Okay, sorry. It's contracted by KFC to supply potatoes. So for us, the value we see...
Unfortunately, the internet seems to be cutting out.
And we've given...
You're back again. Give it one more try. Keep going. If not, I suggest we'll come back to you, Esther. Yeah, maybe you're going to reconnect. But I have one last question, which I think Hillary teed up already a bit, and sort of implicit in the entire conversation we've had, which is, what is the role of subsidy? How can it help make these models successful? Is it needed in perpetuity? What's the right role of the donor? What's the right leverage point for subsidy to be effective? And I'll start again with you, Hillary. What's your perspective? Is subsidy needed? If so, how? For how long? Et cetera. In what ways? Esther, we'll come back to you after this question. Sorry. Go ahead, Hillary.
I think the how question is the critical one here. And Ro mentioned earlier on about guarantee schemes. Again, an area that's quite mixed in terms of results, right? We've seen a lot of cases of programs like USAID's DCA program where, many cases, the guarantee facility is in place and the banks are lending during that period. The minute the guarantee goes away, the lending stops, right? And so how do you do it in such a way that you can actually achieve a sort of proof point that is convincing enough for the bank to be able to continue that lending in the absence of the guarantee, right? That's a real challenge I think we need to look at. I'd be interested in Ro and Esther's view on that. I think secondly, wearing both my Tula hat and the Gates Foundation hat, the way at Tula that we would use subsidy typically is for some of the most expensive work that we had to do, which was the R&D, right? And what you didn't want to do is use your equity for that because your equity was your most expensive money, right? So if you could get grant funding to do that early testing and iteration, that was like gold. Again, because it can be quite expensive. It's absolutely critical for an innovative early stage startup. But again, you're trying to preserve your equity as much as possible. So, I think the message is try to be as targeted as you can with the use of that subsidy in particular areas of the business and for particular purposes.
Super clear and helpful answer, Hillary. Target the subsidy well, right? And I think going back to what you said at the beginning, understanding the context, the sort of the messiness, and then sort of designing specifically for each case, right? There's not sort of a silver bullet here. Ro, I want to turn to you. So Farm Fit Fund, right, is a little bit different in the way, you interact in the space. And I'm curious if what Hillary said, if sometimes, grant in the capital stack actually turns you off as an investor, one. And I also curious how you guys are somewhat sort of using grant funding in your own structure. I understand there's technical assistance. You mentioned the sort of first loss from the DFC or the sort of the lower interest rate capital in your stack, et cetera. So how does grants play a role in allowing you to be an investor in the space?
Thanks, Kusi. Yeah, I think we see examples of companies that are very young, startups, scale-ups that need subsidies because they are not all potentially super profitable, even if they've reached a certain scale, but they're needed in the market. And I think these type of companies you look at with a different perspective. You don't really look at it from a venture capital perspective. We're going to make tons of money if it works. You're looking at, this company plays a very useful role in solving the problems that we face around farmer finance. And against that background, it's perfectly acceptable if there are grants there. So that's my first observation around guarantees. And of course, it also touches upon our fund, the Farm Fit Fund. Let's say the thesis, of course, is you start with guaranteeing a certain business, you scale it, and hey, guess what? It turns to be a very attractive business model. We're not needed anymore, and we will withdraw. That I would say is clear. And whether that will work, of course, that remains to be seen. And I can imagine that in some cases, when the guarantee drops out, that banks say, okay, then it's not worth my while anymore. And I think we also have to accept that. At the heart of what the fund is doing is to test models which are somewhat still unproven or innovative. And we need to accept that some will not work. Some of them will, be on the edge of profitability, and of those of this category, banks or other investors will say after the guarantee is dropped or our participation is no longer there, they will stop the business because it's really not really profitable. But there will also be a category that's really attractive. And that's what we're trying to develop, of course. So I think, not sure yet, but I guess it's a mixed picture.
Great, thank you, Ro. Esther, I'm sorry we cut you off before.
Sorry about that.
So want to hear your perspective on first, I guess, how you're using grants, right? And then second, a little bit about your reflections on partnerships. And it sounded like a really interesting story you were telling us about.
Oh, no, yeah. So what we've then done with our partners is we identified the challenge with farmers is access to certified seed in potato sector. So Agrico comes on board with their technology and their seed and agronomy, and Yara comes with fertilizer tested assumptions of what the optimal yields would be when you combine right fertilizer, right seed, and right agrochemical. And then we have a pool. We then got a pool of all these agronomists, because Yara has the agronomist, Bayer has the agronomist, Agrico have the agronomists. So we have a pool of agronomists who are rallying behind the potato farmers and have also developed a business case for the farmer. And so even for us as a bank, when we are lending to the assumptions not derived by the farmer in isolation, but from the entire partnership. And so Kusi, we find that with a target of 30,000 farmers and well on track, the partners also putting money for CSR and training and capacity building. So we feel, and we've done this even with other sectors. That's how the dairy sector in Kenya was developed, the coffee sector. And so for us, each value chain with the right partners, you unlock and bring the appetites of everybody on the table, and it's a sustainable business. On the DCA program for us, as Bank, it has worked well for us. Some of the sectors that we were not able to get into was basically perception. We perceived that sector as risky, or we perceived that category or that region as risky. But when the DCA program came on board, and I mean, working with USAID and that push from the USAID and the team, the Kenya Investment Mechanism team, and getting our feet in the water, lending and recovery, or having very low, a very level loss portfolio, we realized the sector wasn't as risky as we thought. And so we are then left even with lessons learned and developing more robust products. So for us as a commercial bank, especially Coop Bank, because we don't have a choice, we just have to work with the farmers. The guarantees and the partnerships, particularly with NGOs and development partners, has been incredible in letting us get into spaces that we could not ordinarily get with a commercial eye. And then we got in, and now we can get out because it's actually a profitable business or a profitable value chain.
Great example, and I think speaks to the point of what Hillary was talking about, is sort of R&D funding. Although I have to sort of be honest, we had through the study an experience of working with another bank where there was a donor that was trying to get them to work and serve smallholder farmers. And guess what? Because they had other profitable segments, we couldn't get their attention, right? And so even though, you know, on one side they wanted to serve it, actually getting them to take it seriously was very difficult. So, I mean, I think it's great that Cooperative Bank is doing that, but I do think it still can be challenging. With that, I want to open up to some questions we're getting in the audience. I see one to the chat, and I've also received a couple on the side. I'm going to start with the first chat I see, which is, first question, and I think it's for you, Esther, but anyone is willing to answer it. And so the question is, what is banks' willingness to do value chain finance in a service coalition setting? So Esther, I think you've answered that already, but curious, what's your answer to that question?
Yeah, so I think from bank's perspective, and particularly Cooperative Bank, for us, it's a major value addition. And you know what, Kusi, what makes it even more valuable is having really good partners who are building our capacity. Remember, I'm a banker. I'm not an agronomist. I'm a banker, but I'm dealing with, and even banks that have hired agronomists, I mean, everything is changing so fast. So you're a banker first. But then when you work with partners that also build our capacity as a bank, I may be an agronomist, but my credit colleagues who appraise these cases may not be agronomists. So we depend on them to do a risk assessment. So what our partners do is even train us as bankers. They come to our learning center, we go to their operations. When we started on the potato, Agrico hosted us and we had a crash program on potato, A to Z of potatoes, and their teams from Netherlands were very helpful to help us understand the global potato outlook, and from there we really felt capacity built to even go back and even look at very potato specific products for farmers and other value chain players. And we are now talking of storage, potato storage, new technologies, working with partners. And so it just broadens our thinking. So for us, it's incredibly valuable.
Great, good example, right? It builds new capabilities, uncovers new market opportunities, et cetera. I have another question, which I think I'll direct more to Roel and Hillary. I think as you look at the market, looking for opportunities to invest and provide support, what may be some of the highest potential, most exciting innovations you're seeing to reduce the cost and risk of serving smallholder farmers? Are you seeing anything exciting out there? Maybe I'll start with you, Roel.
Yeah, thanks, Kuzi. Yeah, we see a lot of exciting stuff. There are a lot of companies that offer a different kind of services that help farmers, coming from satellite imaging to software developing, where you can really get good data for farmers. But in particular, let's say super platforms that provide bundled services to farmers. And then the other sides also provide market linkage. And in particular, those we have just approved one that provides such a platform, services to farmers, working together with financial services providers on the ground. So let's say the sponsor is a large telco operating in various African countries. So they do part of the financing now, but later on they will withdraw, and that will be taken over by I would say innovative FSPs. But what also is an important one is to it works together with an agent model. So it's not just online, it's really, and that I think makes it scalable. So I think we're quite excited about that one, because also this telco has some experiences in other sectors, not agriculture, that were very positive. So I think everybody's looking at how can we scale this, and that means that either you do it in such a way, you look at really, and you take a value chain perspective, like I discussed earlier, and link in financial services providers to that. But I think this type of model is quite interesting, and we're very excited to see how it will develop. But it's also still early stage. It needs some subsidy in order to reach the level of profitability, but the potential seems to be there.
Great, thank you, Roel. Hillary, what about you? What are you seeing?
Yeah, just to add to that, maybe build a little bit on what Roel's saying. I would say we're cautiously optimistic about some use cases of embedded finance. So, for example, platform businesses that are offering financial services, not necessarily as a primary source of revenue. So they're in a position to be able to lower the interest rate because it's a means to another end, right? That I say cautious only because there are a whole set of consumer protection and data questions that arise as a result that we need to think through. But we're excited about the potential there. We're also, the other area where we're excited to do more work in is helping different players, public and private, to improve their risk assessment of smallholder farmers using alternative data. I think there's some interesting innovation out there. I think there's also quite a bit of smoke and mirrors out there. So we need to actually just weed through and figure out, who is actually really starting to crack the code on leveraging alternative data to do what effectively doesn't happen really in most of sub-Saharan Africa, which is risk-based lending.
Thank you. And that last point around what's real and helpful versus what's smoke and mirrors really resonates with me, is because funding tends to look for the shiny new, what's attractive, and doesn't always look for what's most effective, right? And so, you know, being very discerning about that is critical. With that, I think we're going to wrap up the panel and the Q&A. I want to thank our distinguished panelists, Roel, Hillary, Esther. It's been fantastic. I found this super insightful. I hope the audience did as well. I'm going to hand it back now to Clara for a final word. Over to you, Clara.
Thank you, Cozy, and thanks so much to our panelists for your openness and being super honest about a lot of, well, many aspects of this topic that are quite controversial. So for me, it's also been super fascinating, but also inspiring to hear from your experiences and your stories on your day-to-day work and how you're living that from a closer angle. If I had to summarize the discussion today on whether there's a business case and impact case, which it was as Iris pointed out, right? What we were trying to find out and we were still trying to find out, I would probably summarize in it's messy and it's nuanced. I think on the farmer side, we clearly saw how the evidence is mixed and the importance of nailing the who and the how of access to finance for smallholders. On the business case, well, we saw from the poll, right? Half. And I think from the discussion, I think it's also where we landed, right? Things can vary widely depending on the type of organization that you are, but also interesting what Esther was pointing and Hillary in terms of the where you are on your journey, how mature you are as a business. Interesting to see that value chain finance, so financing this through the value chain actors, and value chain actors being almost like the customer owner seems to be more attractive, at least for investors, and FSP being that bit of a different animal where the economics might be more challenging. Subsidy, I think there was a clear consensus. It's needed, and even when you're profitable. So that's also interesting. Good also, and a good example from you, Esther, there. I think particularly for, as you said, right, innovation and de-risking. I'll finish with a quote that I really liked, Esther, from you. When we got in and now we can't get out. So hopefully that's, I think, what we're aiming for, to really prove that there's a way to serve this smallholder finance with the right combination of services, including finance. Obviously, we're proud of our research. We developed a methodology. We put a lot of work, but it's just putting a first stone, right? At the end of the day, it's 7 SDMs that we're trying to combine with a lot more agribusiness assessment of agribusinesses, right? But we hope to keep building that data to be able to do much more rigorous analysis and building that evidence on whether there is a business case and then how to get there. For any feedback, questions, want to engage with us, thought this was interesting, I want to talk more, anything, just please feel free to get in touch either with me directly, you find the contact details there, or with my colleague Kusi. Thanks for everyone, and wish you a very pleasant rest of your day.